Yeah, I think China is probably going to be the only country which does this, because they've got exchange control. Actually, actually thinking again, I suppose it's possible that India might do something similar. That's certainly possible. But I think the whole basis of this is that really what we're looking at the moment is what they're doing with gold and securing the value of the yuan for international trade purposes. That, I think, is the key thing. So everything is, if you like, slightly subsidiary to that. I mean, I think it's probably worth commenting on what's happened today. I mean, we've fallen from, 121 or something down to 108 and change, I think.
Well, 112 at present.
Yeah, so it's bounced up weird. I mean, the fact of the matter is that this is the last day of the February contract. Do you need to know any more? Gold and silver get panned. I mean, I was looking at gold, actually, which is interesting. And if you look at gold, you see that there's still 38, I mean, as of overnight, 38,672 February contracts still outstanding. So what do? You bang the price and try and shake the trees and get these guys to close out whatever, just get the hell out of it. I'm sure quite a bit of that will be standing for delivery, which is something else which I think the swaps would try and discourage, because they don't really want to get rid of physical. This is the problem. It's when we look at paper markets, the problem I think we have is not so much speculation. It's more demand for physical. The paper is being turned into physical. Now, we're not leading in this. It's China that's leading in it. I mean, we're overnight. I think silver closed on the Shanghai Gold Exchange at around about 135, something like that, and about 138, I think, on the futures exchange. So, these are very substantial premiums, and it's been like that for some reasonable time. So, and there isn't the arbitrage. I mean, what you're not seeing people sort of, if you like, delivering silver into China and trying to pick up on the arbitrage. That's not happening. And the interesting thing is that it's two worlds again, Jesse. I mean, I keep on hearing reports in the West about the amount of scrap silver and silver coins being offered to bullion dealers, and they don't want to take it. It's partly because it's so volatile, and also because they can't refine it. I mean, there's no refining capacity. So, who wants to take silver in these markets? But if you go to Asia, bear in mind that it was as recently as 1935. I know it doesn't sound recent, but China was on the silver standard. They understand that silver is money. And I remember as a youngster, I was sort of early 20s, late teens, I think, going to the Middle East. And Maria Theresa silver dollars, thalers, were circulating as money. And if you went to somewhere like Basra in Iraq in those days, I mean, there's a whole silversmithing business turning these things into, rings and, jewelry and all the rest of it. I mean, pretty low-grade stuff, admittedly, but you can see that the idea that silver is actually money is something which is far more embedded in the Asian psyche than it is in ours. I mean, we've always seen silver as small change. Yeah.
The real tension today isn't speculation, it's conversion. Holders of futures are increasingly demanding physical metal instead of rolling paper contracts. That's a problem for a system built on leverage. Western vaults show limited available inventory, while much of what's listed is tied to ETFs or restricted ownership. Meanwhile, China's exchanges consistently price silver at steep premiums, reflecting true scarcity. The absence of arbitrage tells the story. Physical metal isn't flowing freely. When paper claims meet real-world shortages, price signals stop behaving normally.
But not in Asia. This is actually, as far as they're concerned, real money. and has been for as long as anyone can remember. So the demand, if you like, when you can see that you've got geopolitical things actually happening, and you've got your own central bank rushing out and buying gold, selling dollars to buy gold, selling US treasuries to buy gold. As the ordinary person, let's say in some regional town in China, what do? Do you go for gold? No, you go for silver. Of course you do. And this is why demand for silver has just gone off the charts. And at the same time, industrial demand is the highest it has ever been. When you look at photovoltaics and also electric vehicle demand for silver is just absolutely amazing. And India in particular is an economy which is now growing very, very rapidly. It's roughly where China was, say, 20, 30 years ago. And its demand for silver, industrial demand, is again off the charts. So there is no silver around. And, people are buying silver, industrial users are buying silver, say on Comex or in London, and effectively standing for delivery. But where does it come from? They haven't got any. If you look at what's in the London vaults, it's almost, not entirely, but it's very substantially ETF silver, which you can raid if you're an authorized participant, but if you raid it today, you've got to pay it back tomorrow. There's an awful lot of the silver which is held in London vaults, which is hoarded, if you like, and therefore not really available on the market. There is just no liquidity in the market. And if you look at the level of open interest in silver, it's low. It's low in gold as well. In fact, it's been collapsing in gold. I mean, we've got 465,000 odd contracts is the open interest in the gold and the Comex gold contract, which is low. I mean, the idea that this is being driven by speculative interest is completely wrong. There is no speculative or very limited speculative interest in certainly in Comex, and I guess also in London. No, it's being driven by monetary factors, in effect, and in the case of silver and also platinum group metals, with industrial undertones.
In much of Asia, silver has never lost its identity as money. China operated on a silver standard into the 20th century, and that legacy still shapes behavior. When uncertainty rises, households don't speculate. They preserve value. Gold may be out of reach for many, but silver remains accessible. This cultural understanding helps explain relentless physical demand across China, India, and Southeast Asia. While Western markets treat silver as a volatile commodity, Asia treats it as savings. That difference is now reshaping global flows.
I haven't actually done the calculations because you've got two markets. So we're only seeing half the story. I think it's true to say that in the case of gold, the short positions on Comex are actually covered by long positions in London. And they're probably net long. I mean, if you bear in mind that at the last LBMA conference, which was where I think it was in South Korea, just a few months back, the consensus forecast was around about $5,000 an ounce. And at the time, gold was around about, I think, sort of four or something like that. So, they were seeing higher prices. Now, I'm cynical enough to believe that, if you're actually short in both markets, you're not going to produce a forecast, if you like, at a conference saying it's going up. No, you're going to produce a forecast saying it's going nowhere or it's going down. So I think it's true to say that the establishment, if you like, as a whole in gold is net long. But of course, they're net long in synthetic gold, not the real stuff. So that is a potential problem as these markets become increasingly destabilized. The case in silver, I think, is somewhat different. I'm sure that there are some long positions in silver, synthetic again, forward positions. But if you look at Comex, I mean, that I think is really where the problem is. No, sorry, let me just go back on that one. there is very frequently a backwardation between London and Comex. Now, what that tells us is that the shortage really is in London, the shortage of physical stuff. But equally, if you look at Comex, the swaps are short. Of that, there is absolutely no doubt. And I think that, if you look at the position overall, I think the establishment is short of silver across both markets. How much is very, very difficult to say. But what we're seeing in effect with people standing for delivery is they're converting synthetic silver into real silver. And that is the problem the establishment has. And there is an additional problem, and that is that because there is so little speculative interest in silver, you can't really shake the trees and get some stock back, if you like, or close off some of your paper liabilities. And that, I think, is the nub of the problem. But the whole thing is being led by the nose upwards by Asian demand, particularly in Shanghai. But also, dealers in places like Singapore are finding they're still queuing around the block to take delivery of physical silver, coin and small bars.
This cycle is different because investment demand isn't acting alone. Silver consumption for solar panels, electric vehicles, and advanced electronics is hitting record levels. India's rapid industrial expansion mirrors China's growth decades earlier, driving structural demand higher. Unlike financial demand, industrial use doesn't sell back during downturns. Once silver is consumed, it's gone. With mine supply failing to keep pace and recycling constrained, the market is losing elasticity. Scarcity is no longer theoretical, it's operational.
Yeah, I think China is probably going to be the only country which does this because they've got exchange control. Actually, actually thinking again, I suppose it's possible that India might do something similar. That's certainly possible. But I think the whole basis of this is that really what we're looking at the moment is what they're doing with gold and securing the value of the yuan for international trade purposes. That, I think, is the key thing. So everything is, if you like, slightly subsidiary to that. They will do that, I think, when they determine that the dollar is really going down. This is something they don't want. And when it becomes absolutely obvious to the world that the Americans are killing their own currency, then I think China can act to protect themselves, if you like, which is actually what they will be doing. But you can see they just, they are sensible enough to know they do not want to be blamed for collapsing the dollar. The dollar has got to collapse itself, which, thanks to President Trump, is roughly what's going on. So I think that's really the first stage. We then have to consider if this is going to be just limited to trade settlement, which I believe is the case. The reason I believe is the case is because central banks, they hate parting with gold. They really do. God, we don't want to give this to the people, for goodness sake. You can see that they really see this as something which, the people shouldn't have. This is far bigger. Okay. So you then have the problem. Well, how do you secure the domestic yuan? And I think that it makes sense. I'm speculating here entirely, but it does make sense given that the history of the domestic market, the domestic Chinese market, was a silver standard. And there is this understanding, if you like, amongst the population that silver is money, whereas we just think it's small change. I think that it does make sense for them to go down that road. And for the same reason, I think it's also true of India. But it does require an effective separation between international yuan and domestic yuan. Now, they do have this with exchange controls. India also has it with exchange controls. So I think those two countries could do it. The yuan itself, when it comes to international trade, I think the Chinese see this as being the single currency which is acceptable to the whole of the Shanghai Cooperation Organization
Central banks are sending signals. Large-scale gold accumulation, reduced dollar exposure, and alternative trade settlement systems point to preparation, not panic. China in particular appears focused on stabilizing international trade value while protecting domestic savings. Gold anchors the external system. Silver may support the internal one. Exchange controls make this separation possible. If this strategy unfolds, it would mark a historic return to metal-backed confidence without overtly challenging the dollar, allowing the current system to weaken on its own.
BRICS. BRICS without Brazil, I'm afraid. And also the entire global south, being the, if you like, the general description of the whole of Africa and elsewhere. So outside the Americas. So I think that, to my mind, does make some sort of logical sense. And I think that's the way in which they're going. We can see it with gold. We've yet to see it with silver. But, is this why the silver is so strong in China? I mean, is this part of the story? Well, it's an interesting thought. I think that what we're looking at, if my suspicions here are correct, then we're looking at the gold-silver ratio certainly going back down to the sort of 15-ish level, which was pretty much what Sir Isaac Newton came up with when he was Master of the Royal Mint back in, 1720, 30, whenever it was. So this, I think, it's a big argument for silver going quite a bit further. And given that the gold is continuing to reflect collapse in the purchasing power of the dollar, then you can make an argument that silver could go 400 or 500 ounces quite easily. And the interesting thing is there are no speculators in there. Normally, you get speculators, it behaves like an investment. There comes a point where, they start taking profits or, the market makers, swaps, whatever, can then shake the trees and bring it back. You get a bear phase or, at the very least, probably a bear market. But this is a very different situation. This is not an investment game. This is a big, big monetary game. And it's the end of the fiat currency system. And that, I think, incidentally, is going to accelerate very significantly in 2026. Because what gold is telling us, the relationship between gold and the dollar, is that the purchasing power of the dollar is going to fall a lot more rapidly than anyone thinks. Or put another way, the rate of inflation in 2026 and going into 2027 is going to be far, far higher than anyone at the moment can imagine. And that, I think, is going to be the big surprise on the markets.
What makes this moment extraordinary is who's missing. Speculators. Open interest in both gold and silver is relatively low, meaning price action isn't driven by momentum traders. That removes the usual release valve. When demand is monetary, not speculative, there's nothing to shake loose. Historically, such conditions lead to abrupt repricing, not gradual rallies. With inflation pressures building and fiat confidence eroding, metals aren't rising, they're recalibrating. This isn't a trade, it's a transition.